If you log into your brokerage account today, you might see something confusing. The S&P 500 is hitting record highs, but if your portfolio is concentrated in the tech giants that drove the last 3 years, you are likely losing money. The market has fractured into two entirely different directions. This line graph shows the divergence. The S&P 500 ETF climbed 10% this year, but the Magnificent Seven are sliding into correction. Look at this third line rocketing upward. The S&P 493 and small cap value stocks are surging, hitting 21% returns. The bull market hasn't ended, it has broadened. Big tech is no longer the primary engine. Instead, those high valuations are effectively inflating the rest of the economy. This creates a specific dilemma. Do you hold on to bleeding tech stocks because you believe the AI boom will eventually lift all boats? Or do you shift your capital now to capture the momentum in the sectors that are actually leading this leg of the rally? Staying static while the market fragments means holding assets that are losing momentum while ignoring the sectors driving the new record highs. It's a strategy that keeps your concentration risk high just as the market's easiest gains have moved elsewhere. Let's weigh the first strategy, holding the line on tech. You accept the current correction to ensure you're in place for the massive, ongoing AI infrastructure rollout. This chart shows the capital fueling that thesis. Hyperscaler capital expenditures are projected to hit roughly $720 billion by 2026. That spending is the backbone of S&P 500 earnings, with tech-related companies adding a projected $21 to the index's EPS target. However, look at this line chart tracking the S&P 500's price-to-earnings ratio. Valuations are in the top 5% of historical ranges. You are paying a high premium to own those tech earnings right now. If earnings growth slows even slightly in 2027, or if interest rates stay elevated, investors may stop paying these 24x multiples. That alone could trigger a significant drawdown in tech prices, regardless of how much they spend on AI. That leads to the second strategy, trimming your tech winners and rotating into the surging broad market. This matrix shows where the momentum is actually sitting today. While tech stagnates, emerging markets are up 30%, small caps are up nearly 22%, and value stocks have gained over 15%. But remember the trade-off. These smaller companies don't have the cash reserves of big tech. They are far more vulnerable if consumer spending slows or the economy hits a sudden rough patch. Betting purely on tech exposes you to a valuation crash. Betting purely on small caps exposes you to economic fragility. To navigate this, we need to look at the crossover points. There is a hybrid approach, the picks and shovels strategy. This means buying non-tech companies that are the physical beneficiaries of the AI build-out. Look at the industrial sector. They supply the electrical hardware and grid infrastructure required to power and cool those digital data centers. The trade-off for picks and shovels is that it isn't passive. It requires active research into individual stocks and specific ETFs, which is a higher hurdle than just buying the S&P 500. But there is one macro force that complicates every strategy: the Federal Reserve's shift under Chairman Warsh. The Fed is now removing forward guidance. They are no longer telling the market what to expect, which makes every inflation data point a potential source of high volatility. This dot plot shows the challenge. Look at the cluster for 2026. Most Fed officials expect rates to stay between 3.5 and 4.25%. We are in a higher-for-longer environment, where a rate hike is just as likely as a cut. High rates punish passive bondholders, but they create lucrative opportunities for those who can navigate high-quality credit and carry trades. To succeed in this broadening market, you have to balance the physical growth of AI against the financial gravity of a hawkish Federal Reserve. The S&P 500's ability to climb despite a tech correction isn't a fluke. The index itself has fundamentally evolved. Today's market is asset-light and service-oriented. It's far less sensitive to energy costs and oil shocks than in previous cycles, which helps protect earnings even when commodity prices swing. Because the market's underlying composition has changed, a static portfolio focused only on the biggest names no longer reflects the reality of where growth is happening. Relying solely on tech megacaps is no longer enough to capture the index's performance. Rebalancing is now the primary tool for aligning your capital with this new, service-driven market structure. This rebalancing roadmap offers 3 paths. Tech-heavy beginners direct new cash into small-cap or value funds. Anxious optimizers trim expensive tech winners, moving capital into industrials and mid-caps. Income-focused investors sidestep volatility, using high rates for credit and carry trades. Audit your tech weighting today and choose the path that matches your risk level. Start reallocating your capital to where the momentum is actually moving. The AI infrastructure cycle is still unfolding, but the market's internal dynamics have shifted. Success through the rest of 2026 requires moving past simple tech dominance and positioning yourself for the broad market breakout.